we now have what we call our bull pennant. So what is a bullish pennant? It is a continuation pattern. Another continuation pattern, very key to notice that to note that is a continuation pattern that marks a pause in the movement of a price halfway through a strong uptrend, giving you an opportunity to go long, which is buying and profit from the rest of the price rise. So it's just a short break before the continuation price of that direction, right? So how does it form? Bullish pennants occur just after a sharp rise in the price and resemble a triangular flag as price moves sideways, making lower highs and higher lows. So that's basically how this comes into play. The uptrend then continues with another similar size price after the movement. So the market will be coming from downwards, and then once it completes with the lower highs and the higher lows, it basically will have a breakout and try to move the same distance that it has moved here, right? So that is what we're trying to say over there. How do you actually identify a bullish pennant? So before the pennant forms, the price basically experiences a sharp rise. This is known as a pennant pour. So it's almost similar to the flag, but now we're having our flag in the formation of a triangle, right? So the pour can represent either the start or continuation of an uptrend, and its size is important when you calculate where to place your take profit target for your buy. So the triangular pennant is usually very small in relation to the size of an overall uptrend. So this pattern can be hard to spot. With the practice, you will learn how to recognize it much easier. So how do you actually trade the bullish pennant? So you enter your buy as soon as the candlestick closes above the pennant's upper line. So what you mean by this, this is the upper line, as you can see right here. So this is the one that is being made by the lower highs as the market is moving down and consolidating, right? That is where as soon as the candlestick closes above that line, that is where we're looking for our entry points, and then that's where you enter the market, right? So, and then when it comes to stop loss, you place it on the other side of the pennant. So here it is making the higher lows. This is where we are getting our support line, and then here just below that trend line is where you place your stop loss. And then when it comes to taking profit, your take profit target should be the same size of this pour, right? So you should measure the size of this pour. So the initial price rise, how much the market rises on that pour, and that should give you your take profit target. But again, it is wise to use a trailing stop loss so that you can capture the most out of this. But that's basically how you figure out your take profit point. So place your profit target the same distance above the pennant breakout point. If the initial rise was 80 pips in size, you should place your profit target 80 pips above your entry point, your trade entry point. So this is a bullish pennant, as you can see. If I can just clear out the marking so you can see clearly how it looks like. So with practice, you'll be able to figure it out and be able to spot it much easily on your chart. So very, very key to understand this point and the psychology behind it. So as you can see here in a more market structure, again, as you can see, we have our pour right here. And then after that, we have this consolidation phase. And after that, we have the break over there, which shows the continuation of uptrend. So remember, we only enter after this candlestick that breaks and closes above the resistance line, right? So this is giving us our resistance line, forcing the price to go down. But then as soon as it breaks out, that means the continuation is starting, and you should be able to capture your trade right there, your entry point, and your stop loss should be somewhere below this lower supporting line, right? Below the supporting line that you're having over here. So the bullish pennant is a continuation pattern found in an uptrend, and it alerts of possible buying opportunities if you miss the beginning of this uptrend over here. So you can either actually make use of this to enter more positions to maximize your profits. So entry takes place just after resistance level has been broken, either on the breakout, so exactly when it breaks out, which is more safely, because if it's an uptrend, the momentum is a lot, you might not see a retest that may come so that you can give you an opportunity to enter. But basically you can also enter at the retest of that pennant when it comes back to retest the market. So either of two provides perfect opportunities for you to enter the market. Hence why we also put our stop loss way below here, so that even if it comes back for a retest, you won't be stopped out. Because if you're going to put your stop loss somewhere around these levels, you will be stopped out before the market actually goes up. Because remember, sometimes the market has to come back to retest that level that it has broken, so that you can move forward in that direction, right? So the stop loss is placed below the opposite trend line, and take profit is placed the same distance above the entry point as the height of the pour, the initial price rise. So that is what we are saying over there. So to show you in an example, in a market on an actual chart, this is basically how it looks like. As you can see right there, we are able to catch this one over there. As you can see, this is the before. We're just going to show you the after as well, what actually transpired. But as you can see, we had our pull over there, which was a pull, and then we have our lines over there. So we have our trend lines, and then we were expecting a breakout obviously over there. So as you can see, we actually have an order over there, a pending order, so that we can enter the market as soon as it breaks out of that level. So that's another thing that you can make use of. So take a look at what happened here. Such a perfect trade that we were able to capture right there. As you can see, our order was triggered over there, and we were in the trade. After that, pennant actually formed over there. So as you can see, it comes in different shapes. It doesn't have to be necessary pointing to one direction like what we drew it looking like. But basically, as you can see here, it's actually in a form of an uptrend sort of pennant. So basically, that is how it played out. As you can see right here, it was very profitable, and we're able to capture this trade, and we're able to make the most out of it. And be careful of the retest. As you can see right here, it came back to retest this level, but we were able to hold this trade all the way up here. So that's why we say your stop loss levels should be somewhere below the lower level, right? Below the lower uptrend level. That is the best place to place your stop loss. Otherwise, if you place it too close to your entry point, you might be stopped out before it actually moves in your direction, the overall direction of the market. So the bearish pennant is basically the opposite of the bullish pennant, and is also a continuation pattern. But this point, it's a continuation pattern in the strong in a strong downward trend, so offering us an opportunity to short the market, meaning to sell in the market. They occur just after a sharp drop in price, which resemble a triangular flag as the price moves sideways, making lower highs and lower lows. The downtrend then continues with another similar sized fall in price. So when we say similar size fall, remember we said the price, we expect it to move exactly the same amount of pips that it moves in this initial pull, in this initial price drop. So that is what we are expecting for it to start. After it breaks out of this level, we're expecting at least a similar move of the same amount in size. So it can be more than that, it can be less than that, but basically that is what we are anticipating. How to identify a bearish pennant. So pull of the pattern, which is this right here, before the flag part of pennant actually forms, which is this part over there, we have the pull, right? So price experienced a sharp drop. This is the results of a sharp drop in price that has just occurred. So this is what we call the pennant's pull. So the pull can represent either the start or continuation of a downtrend. And this size is important when calculating where to place the profit target for your sell trade. So the triangular pennant itself is usually very small in relation to the size of the overall downtrend. So this pattern can be hard to spot, but with practice, obviously this will become easier. So how do you actually trade the bearish pennant? Enter your trade as soon as the candlestick has closed below the pennant's lower trend line. So right here, this is where you enter your trade. Place your stop loss on the other side of the pennant, which is over here. This is where you place your stop loss. And remember, we said a little bit pips away from that point so that you can have some room to breathe in case a retest can come and break through these zones and then actually come back to, depending on how far away this point is from where the breakout is, right? So it might only be this far, it might only be this far and not that far. So it's very key that you move it a little bit higher than where that point actually is, but still maintaining your risk to reward ratio, right? And maintaining your risk management plan. So just above its upper trend line, that's where you put your stop loss in a downtrend, continuation pattern, which is the bearish pennant, right? So place your profit target by measuring the initial drop of the price. So the initial price of this, how many pips this actually is fell by, that is what we call the initial price. Then that is the amount that you're gonna put here and measure for you to have your take profit. So you have your TP point, that is how you measure it. So for example, if the initial price drop was again 80 pips in size, you should place your take profit 80 pips underneath your trade entry point, so that that's where you will be able to exit. But again, I'm going to mention this one more time, it is wise for you to make use of the trade stop loss so that you can make the most out of this move in case it actually continues in the direction for 2 times, 3 times more than that 80 pip move that we are anticipating. So it's very key that you make use of that technique. Very, very powerful.